Welcome back, and this lesson we are going to learn about something exciting and important. And you know, it never ceases to amaze me in the real estate business how few people can really do their darn math right. You know, you'd think it'd be kind of simple, but it's apparently not. Even surprisingly, seemingly sophisticated people who are doing all kinds of big deals, they are still puzzled by the math. And it's just sort of common sense math. So one of the great things about income property is that it is a multi-dimensional asset class. And many would tell you that it is the ideal asset class. So let's explore that. In this lesson, we are really going to learn how to calculate return on investment, ROI. I've been called the ROI director by many people. And so let's dive into this today, and let's look at how income property is a multi-dimensional asset class. So we're going to learn how to calculate ROI, what factors make it increase and decrease, as we talk about in many lessons. And ideal when it comes to income property is really an acronym. And there's a little bit of difference of opinion in what this acronym stands for. But most people would say the first letter, I, is for income. The second letter, D, is for depreciation. Now, depreciation might sound bad, but when it comes to income property, it's wonderful because we're talking about the depreciation write-off that we get on our properties, even if the property is producing positive cash flow and it's appreciating in real life. The IRS may consider it to be depreciating on a schedule. This is what's known as a phantom write-off or a non-cash write-off. And if you and your properties can qualify for it, it is, in my opinion, the holy grail of tax benefits. Now, some people get kind of bored when we talk about taxes, but what you have to realize is that taxes are not boring. They are the single largest expense any of us will have in our lives. And we have got to learn how to manage and reduce our tax liability. So income property is, in my opinion, the most tax-favored asset class in America. It is absolutely beautiful when it comes to taxes. The E stands for either equity, expenses, or exchange. There's a little bit of different opinions about what the E stands for, but let's take all three of them. So of course, with income property, you can build up equity because the tenant will pay off your loans. My method of inflation-induced debt destruction that I talk about extensively, that is another way to have inflation pay off, in quotes, your loans, your financing, your leverage on that property. And expenses, those are tax deductible. So just like any business, income property is a business, and you can write off a bunch of expenses, some of which you might normally have anyway. So it's really good like that. And then when you sell it, if that asset is appreciated in value, you can take and you can do a 1031 tax deferred exchange, and you can defer the gain into the next deal. And you can do this all throughout your life under current law. So you keep deferring, and you just postpone your tax bill indefinitely. So a 1031 exchange is a fantastic opportunity. You cannot do that with a business. You cannot do it with stocks. Only certain asset classes like income property offer that opportunity. And of course, property appreciates. So real estate appreciates over time, and that is another fantastic benefit, another thing that makes it ideal. The L is for leverage. As we've talked about in the course, Archimedes said, give me a lever long enough and I will move the entire world. So you get leverage. You can put only a part of the investment down. So say, for example, you put 20% down, you get to control an asset that is 5 times the price. And you get to control that asset in a way that you can increase your wealth at 5 times the speed if you have that 5-to-1 leverage ratio. So that's just an example. If you can get more leverage, hey, more power to you. Leverage is great. But this is why income property is ideal. IDEAL, because it has these fantastic features. It is a multi-dimensional asset class, and that's what makes it the most historically proven asset class in the entire world. So calculating ROI, some of the key factors: income, of course, the rent net of vacancy, and the appreciation in this way that we're talking about it needs to be considered part of income. The expenses, so you're going to subtract the expenses from this, managing, maintaining the property, disposing of the property eventually, and the investment. How much money did you put into the deal? So these are the factors that go into ROI, and you're going to add them all up. You're going to subtract the expenses. You're going to divide by the total amount invested. This is how it looks for you visual learners. Here is the equation in sort of graphical format. You've got the income, that's the rent and the appreciation largely, the expenses, and then you divide the cash invested into the deal. So what factors make it increase? Well, obviously, like so many of the other metrics we talk about, increasing rents, higher cash flow, value appreciation, higher value upon sale or refinance, because you can also calculate return on investment based on refinancing the property. That's one of the beautiful things about income property, is that you can put your money into the deal, acquire the asset. Later, you can refinance the asset, get all your money and maybe even more than all of your money out of the deal, but you still own the asset. Beautiful, beautiful thing. That's why it is the most historically proven asset class in the world. Expenses. Well, you want to keep your expenses low, of course, and you can keep your repairs to a minimum. You can manage the property yourself, keep your vacancy rate low, and then, of course, higher leverage. That's going to mean that you control more with less with that smaller down payment. So the takeaway here is that this is mostly about increasing the performance and decreasing the investment, or doing both at once. What factors make ROI go down? This is all pretty self-explanatory when we look at all of the different metrics we're looking at in this module. But of course, decreasing rents, that's bad news, right? You don't want to have rents go down. You don't want to have the property depreciate in value. You don't want to have higher costs. You don't want to have your management fees or your repair or vacancy go up or your taxes go up. And so here, if you have any of these, that would be bad in the expense category. But what about in the investment category? What if you have to put more money into the deal rather than less? If you get less leverage in the deal, then that is going to decrease your ROI, because you control less with more versus controlling more with less. More leverage is almost always better than less leverage. Don't believe what anybody else tells you. Leverage is good as long as it's long-term fixed rate, as long as the property can sustain the leverage, meaning you're outsourcing your debt service to your tenants, and that means your tenant is paying for the leverage, not you. So that is a beautiful thing. So decreases in ROI come from lowering the income, increasing the expenses, or increasing the investment, or both. Okay, what about the 3 basic economic maladies: inflation, deflation, and stagnation? Well, if prices go up, the purchasing power is declining. If this drives increases in rents and property values, this is going to be a good thing. We like inflation as real estate investors. Deflation, not so much, because we have falling prices and increasing purchasing power of the currency. But remember, if we're using leverage in an inflationary environment, we're getting paid to borrow. If the environment is deflationary, we're having to pay more to borrow, because the value of that debt increases. This is the opposite of my favorite technique that I call inflation-induced debt destruction. Okay, so deflationary times are a great opportunity to acquire more assets at bargain prices. Stagnation, this just kind of means nothing's going on, right? Everything's sort of flat. And positive cash flow protects you against stagnation, and it gives you staying power to stay in the deal. So the takeaway is that the strategy for successful real estate investing, it's different during these three different times. This is one of the other things I absolutely love about income property investing, is that unlike other investments where you buy in, and you buy in with a strategy that says, hey, I'm going to buy low and sell high. And that's my whole strategy. If I was buying gold or silver or precious metals or non-dividend paying stocks or a business even, my strategy would be limited to this flat, one-dimensional scenario. Versus income property, my strategy is multi-dimensional. That's a beautiful thing. And not only that, if I bought the property right and structured the deal right, I get to change my strategy as I go with changing economic times. Another reason it is the most historically proven asset class in the world. Okay, so action items. We talked about ideal. Remember that acronym? Remember that income property is a multi-dimensional asset class. Write that down. Jason says it's multi-dimensional. So what are your action items? Well, calculate the full ROI on a property with the three basic scenarios: inflation, deflation, stagnation. Your badge action will be to use the template, enter the relevant information, and you can do this for 3 target properties. That would even be better. And then the spreadsheet will do the calculations for you based on inflation, deflation, stagnation, and just upload a screenshot and you'll get your badge, and we'll talk to you on the next lesson. We've got some good stuff in this module that is really going to make you an excellent real estate investor. You got to learn the math, and some people don't like math, some people love it, but you got to learn it. And most of all, it's pretty easy, except for one. We'll see about that in a moment.